Not all agency errors and omissions policies are the same. So what are the major differences? And how do agencies decide what limits to buy? Lisa Doherty, CEO of Business Risk Partners, has Agency E&O as one of her company's specialties. She answers these questions and also discusses whether now is a good time for agents to shop around for their E&O coverage.
There are some policies that are just claims made, so as long as the claim is made against you during the policy period, that policy will apply. If it's a claims made and reported, the claim has to be made against the insurance agent and reported to the carrier during the policy for the coverage to apply. So it's a subtle distinction, claims made versus claims made and reported, but it makes a big difference in terms of the applicability of coverage if you don't report properly. So that's the first thing to look at. The professional services definition, most of these are tailored to write the services that you provide. You really want to make sure if you're doing some claims adjusting or if you're doing loss control or other ancillary services, premium finance, for example, you want to make sure that that's spelled out in your definition of professional services so you're covering everything that you might be doing as an agent and broker or related to that. The insolvency exclusion is another one that people really should be paying attention to. The way the insolvency exclusion typically works is it will allow a carve back for placements that are made if the rating was at a particular level at the time the placement was made. Perhaps it's A-. If AM Best says that this insurance company was an A- at the time that you made the placement, then coverage for insolvency of that carrier subsequently will be covered. Now it becomes more difficult on some of the unrated carriers. Some of the healthcare companies are less and less rated. AM Best is doing less rating, so you need to make sure that you either carve that back with your carrier or understand that if you're doing business with some of those carriers. And some policies will just exclude insolvency altogether because they don't want the potential aggregation of if a major insurance company goes down and all of these agents have policies there that then become problematic. So that's another thing I'd look at. And you know, obviously you need to look at exclusions in a policy form and make sure, you know, there's some people who will insure an MGA and then exclude breach of underwriting authority. Well, that's an obvious exposure for an MGA that they need to have. You need to look for those kinds of issues in each policy. It's a really fluid market at the moment. We've had a few people exit. We've had a few more people come in, and you know, there's a couple of markets who have been very big players in this space, Fireman's Fund and Westport, who have been consistent and are the big players. But there's a lot of other players who have been in and out. I'd say it's a good time to be looking, but be mindful of the coverages, as we talked about earlier. You want to really make sure you're not changing from a claims made to a claims made and reported. And if you are making that change, to understand what you might have in the pipeline to make sure it gets properly noticed. Oftentimes when you change policies, you have to sign a warranty of not knowing anything that might give rise to a claim. And once you make that warranty to the state, to the new carrier, if there is something that you know of, you really need to make sure you notice the old carrier. And if you're a national organization with 22 branch offices, you really need to make sure that you've talked to the El Paso branch and that you know what's going on there, and the Vermont branch, so that you're not missing something, because the onus is on the insured to bring out anything that might possibly give rise to a claim. I, as a business owner, ask myself too, what should I carry? A couple of things. Obviously, some carriers require a certain limit via contract. That's an easy one because it gives you a sense of what you need to buy. But I would also look at what are the types of coverages you're placing? Are you placing really complex risk with high limit profiles? If you're placing a $25 million program and buying $2 million of E&O limit, you know, that just doesn't make sense. So you need to look at the exposures that you've got. You also want to think about the assets that you're trying to protect. If you've got $10 million in the business, somebody might go after that $10 million, and if you've only got $2 million of E&O, the next 8 might come from the assets that you've got in the business. So those are sort of the 3 things that I would look at. I would be disingenuous if I said it didn't matter. So it's sort of that double-edged sword. The more you buy, potentially the greater the settlement. But I think there's incredible pressures if you don't buy adequate limits, because it forces the carrier into difficult positions in claims handling. If you have $1 million limit and the total exposure is $10 million, the carrier has less options in terms of what it can do to help you settle. And so you really want to make sure that you don't put them in an adverse position because there's more exposure than there is limit.